Today, we're focusing on Nvidia, one of the biggest players in the AI space. With a recent 20% drop in stock price, many are wondering, is this a temporary dip, or are Nvidia's best days behind them? Stick with me as I break down the key facts, uncover the reasons behind the decline, and explore whether this could actually be a prime buying opportunity. Welcome to Profit Protection, your trusted source for insightful market analysis, proven investment strategies, and actionable tips to help safeguard and grow your wealth. If you are new to the channel, please subscribe to the channel for all of our updates. Okay, with that out of the way, let's start by examining why Nvidia's stock is down 20%. This decline follows better than expected earnings reports, which is puzzling for many investors. Nvidia posted strong earnings, and yet the market reaction was overwhelmingly negative. In fact, Nvidia saw one of the biggest single-day drops in stock market history, losing nearly $279 billion from its market cap in just 24 hours. So what's driving this? First, Nvidia is facing increasing regulatory scrutiny. The U.S. Department of Justice is reportedly investigating potential antitrust violations, with claims that Nvidia may be limiting competition in the AI chip market. The concern is that Nvidia's dominant market position is creating a monopoly that restricts consumer choice. The DOJ is exploring whether Nvidia's business practices, including preferential treatment for customers who exclusively use their products, are anti-competitive. While Nvidia denies any wrongdoing, stating that their success is purely based on the quality of their products, it's important to understand why this investigation matters. Companies like Microsoft and Meta spend over 40% of their hardware budgets on Nvidia's AI chips. The fear among regulators is that if Nvidia controls too much of the market, they could stifle innovation by making it difficult for competitors to catch up. If these allegations hold, Nvidia could face hefty fines or be forced to alter its business practices, potentially cutting into their massive profit margins. But it's not just about legal challenges. This recent dip is also driven by something deeper: investor expectations. Despite posting better than expected earnings, Nvidia's stock took a nosedive because investor expectations were sky high. Analysts had already baked in significant growth, and even though Nvidia beat earnings estimates, it wasn't by a large enough margin to sustain their soaring stock price. As Chris Johnson recently pointed out, Nvidia fell victim to what's called the euphoria trap. When a company outperforms repeatedly, as Nvidia has done, investors start expecting perfection. Nvidia has been on an incredible run, driven largely by its dominance in AI chip technology and its GPU hardware used in data centers worldwide. But when a company doesn't exceed already lofty expectations by enough of a margin, investors start selling off. Nvidia's stock had essentially been priced to perfection, meaning even a solid earnings report wasn't enough to keep the stock climbing. Investor psychology plays a massive role here. Market sentiment often drives stock prices as much, if not more, than actual performance. Nvidia's stock rose dramatically over the past 2 years, partly because AI was seen as the next big frontier, and Nvidia was, and still is, leading that revolution. However, when those earnings didn't completely blow expectations out of the water, it triggered a reversal in investor sentiment. This shift in sentiment is crucial to understanding why Nvidia's stock has dropped. Think of it this way: when investors are overly optimistic, stocks can become overvalued. This is exactly what happened with Nvidia. In the months leading up to their earnings report, analysts raised price targets and investors flocked to the stock, driving it higher and higher. But when Nvidia didn't beat those expectations by a wide enough margin, we saw a psychological shift. Investors who had been riding high on the AI hype began selling off, triggering a correction. This shift from euphoria to disbelief is a common pattern in the stock market. Now, Nvidia is entering the acceptance phase, where investors are adjusting to the fact that the stock won't keep skyrocketing at the same pace. This is part of the normal cycle of the stock market, but for long-term investors, it creates opportunities. The third factor contributing to Nvidia's recent downturn is the time of year. September is historically the worst month for stocks across the board. Over the past 20 years, the S&P 500, NASDAQ, and Dow Jones have all performed poorly in September, and Nvidia is no exception. In fact, Nvidia's stock has averaged a 6.8% drop during September over the last 5 years. This seasonality is something many investors overlook, but it's important to understand that stock prices don't move in a straight line. Markets are cyclical, and September is notorious for being a tough month. The volatility we're seeing in Nvidia right now is partly a reflection of broader market trends. This September dip isn't a one-time event either. Historically, Nvidia's stock has struggled during this time of year. Even during its so-called AI era, Nvidia has underperformed in September, which makes this recent drop less surprising. Understanding the timing of market trends is crucial for navigating the current volatility. So, with all these factors in play, the regulatory scrutiny, investor expectations, and seasonal market trends, what does this mean for long-term investors? Is this recent dip an opportunity to buy Nvidia at a discount? Nvidia has already broken through some key support levels, including the $120 mark. The next critical level to watch is $100, which is a major psychological barrier for both institutional and retail investors. If Nvidia breaks below this level, the next support zone is around $80, which could represent a further 20% drop from current levels. However, for long-term investors, this could be a great buying opportunity. Nvidia is still the leader in AI hardware, and the demand for their GPUs isn't going away anytime soon. The company controls about 90% of the data center GPU market, and with AI becoming increasingly important in industries like healthcare, finance, and government, Nvidia's long-term potential remains strong. Chris Johnson pointed out that Nvidia's stock has gone through these corrections before. Nvidia has experienced dips of 10% or more 31 times in the past, and each time the stock has rebounded to reach new highs. This kind of volatility is part of the game when investing in high-growth companies. As we look forward, it's essential to understand the technicals. Nvidia's next major support level is around $100. This round number holds psychological significance and is also where we've seen significant options activity. If Nvidia breaks below this level, the next target is $80, a 20% drop from the $100 mark. This could happen if we see further market volatility or if regulatory concerns intensify. However, for long-term investors, this presents an opportunity to accumulate shares at a lower price. Dollar cost averaging, buying more shares when prices are low, can be an effective strategy during these dips. Nvidia is still a leader in the AI space, and their innovation in GPUs, data center technology, and accelerated computing gives them a strong position in the market. Even if the stock drops further, Nvidia's long-term prospects remain solid. The AI revolution is just beginning, and Nvidia is at the forefront of this technological shift. Companies worldwide are investing in AI infrastructure, and Nvidia's GPUs are critical for training AI models, running data centers, and advancing self-driving technology. It's also worth noting that Nvidia's gross margins remain incredibly high, around 75%. This is one of the reasons they've been so profitable, and despite the recent dip, their stock is still up over 100% year-to-date. Nvidia's dominance in the data center market gives them a significant advantage over competitors like AMD and Intel. And while companies like Google, Amazon, and Microsoft are developing their own AI chips, Nvidia's CUDA ecosystem and massive developer support make it hard for competitors to match their offering. In the AI era, Nvidia's products provide up to 25 times lower compute costs and 84 times better energy efficiency than traditional CPUs. This means that even with rising competition, Nvidia remains the go-to choice for companies building AI infrastructure. So, is Nvidia still a smart investment after this 20% drop? The answer depends on your time horizon. For short-term traders, there may be more volatility ahead, especially as regulatory concerns and seasonal market trends play out. But for long-term investors, this dip could be a golden opportunity to buy into one of the most innovative companies in the world at a discount. Nvidia's fundamentals remain strong, and their leadership in AI hardware is unlikely to be challenged anytime soon. As long as the demand for AI continues to grow, and all signs point to that happening, Nvidia is well positioned to benefit from the next wave of technological advancements. So while Nvidia's recent drop might have sparked some fear, it's clear that the company remains a key player in the tech landscape, especially when it comes to AI and data centers. But this isn't the only challenge Nvidia faces. The global chip war between the US and China is another looming factor that could have massive implications for Nvidia and other major tech stocks. If you want to dive deeper into the global chip battle and understand how it's shaping the future of technology, be sure to check out my video titled The Untold Story of the US-China Chip War on Major Tech Stocks. You'll gain valuable insights into how geopolitical tensions could impact the entire tech industry, including Nvidia. Click here to watch now and stay informed about the forces shaping the future of your investments.